Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here with the Last Week in Mortgage Today, our weekly whirlwind through all the things going on in the mortgage industry, and no shortage, as usual, of news stories and things to bat around this week. And each week, I'm pleased to be joined by one of our lender members as my co-host. And this week, lucky to have the president of Success Mortgage Partners, Allison Johnston. Allison, thanks again for joining me.
Thank you very much. I appreciate it.
Excellent. And Success based one of our earliest members, Allison, on our board of directors, and based out of the epicenter of the residential lending world, Michigan.
Yeah, lots of excitement going on here for sure.
And as somebody that is dialed into the Michigan mortgage banking scene as anyone, I'm curious to get your thoughts on some of the goings on up in that state up north, as we call it in Ohio. And but before we go there, how did 2020 end up for you guys? And these first 2.5 months of 2021, would love to just hear your perspective on the volume ebbs and flows, and anything else exciting you guys have in the hopper as we head into the spring here.
Well, last year was fantastic. I wish I would have known in February and March how it was going to turn out, because I think I lost 8 years of my life just in those 2 months. But it turned out to be a great year. We were up 115%. We capped out about $2.8 billion. So, tough, but we were happy to get the business. So this year, so far, apps have been up and down a little bit as rates have moved. I don't think we're going to be as heavy refinance this year. And the new 1003, that was super fun. That really put a setback to some of our loan officers, trying to maneuver through the new 1003, of course, trying to get loans through USDA. They weren't quite as prepared as we had anticipated. And just really making sure that 1003 with all our automation did break quite a few of our bots that we have. So we had to go back and fix it. But applications overall have been strong. I mean, we still, are closing anywhere from 250 to 300 million, which is great, for March and last month as well. And just really this year focusing on automation, which has really been big for us, building bots and programming, just to make sure we're very efficient. Last year, we ended up probably hiring about 235 people, which was really interesting in a remote model. We hadn't been through that. We've gotten very good at using Zoom and RingCentral and training and, our cybersecurity. But this year, we're really focused on growth going into additional states. I don't think we'll hire as many people, but that's one of the main reasons really why we want to focus on automation and building more bots to do tasks.
Well, kudos to you guys on a great 2020. Seems like not long ago, couldn't have been more than a couple of years ago. I remember talking to you guys when you guys finally got over the $1 billion a year threshold. And
we did.
All of a sudden, hiring over 200 people in 1 year and $2.8 billion in production. So good to see good things happen to good people, and happy for you guys. So
thank you.
Cool. All right, well, let's get into it. And as always, encourage interactivity. Any questions, comments, thoughts, jokes, whatever, feel free to type them into the chat or the Q&A, and we'll incorporate them into the program. Allison, let's start with the recent announcement by Fannie Mae, pulling back the reins, so to speak, on investment properties, second homes. Really has created a lot of discussion amongst our members, some ripple waves already in the residential lending industry. Been hearing reports of, a lot of the aggregators adding big delivery fees to non-owner and second homes. So we'd just love your perspective on the announcements by Fannie Mae, what you've seen so far, and your thoughts on how this could impact the industry short and long term here.
So that 7% cap was a little surprising. We ran our pipeline and kind of looked at where we were at, and we're a little bit over that 7% mark. But then we also have a servicing portfolio and sell to tier one investors. And the problem is trying to figure out that balance where we're going to put our price hit in. And one of the things that were interesting is some of the tier one investors and other investors are all over the board. I've seen some investors put a 9-point hit in for investment and a 5-point hit for second home. So pretty much they don't want those loans, right? So then we have to figure out where can we price feasibly to make sure we're going within the threshold. We can still do that type of production. There are some investors that have not come out with anything yet. We have some investors that said they're not going to, and I believe that will be short-lived. As soon as they find out they'll be adversely selected to get those types of deals, I think they will be putting in a price hit. But I have heard from some independents that they've gotten calls from Fannie Mae that says they're above the threshold. What is going to be their plan for what they have with their volume and their investment and second homes? So I think we're all trying to figure out where a price hit's going to be, what that means for future business. I would hope that this is short-lived, but you know, you never know. But I think just in the mortgage business, we've had some surprises that have come up, you know, from the FHFA with price hits, and we just have to adapt to it. And really just, I've heard that it's a rolling 52-week period, but there's really not a good reporting structure to try to figure out, you know, what if you sell to Fannie Mae and you're selling to aggregators, you know, what does that look like overall? So I'm hoping they're going to be sending out some more clarity. But for us, we put in a price hit that we thought was reasonable. We let our sales team know that, you know, it was effective immediately and that it could be subject to change just because we don't know what some of these aggregators are going to do with, you know, and the tier one investors with their price hits. But some of them have just been crazy. We won't be selling second homes or investments to them at all.
This is the last week in mortgage today. I'm joined by Success Mortgage Partners President Allison Johnston, and would love to hear from any of you in attendance, what you're hearing and seeing in the secondary market from those you sell to on investment properties and second homes. We've reached out to Freddie Mac, haven't heard anything back from them. Anything from Freddie? Anything you've heard that could be coming? I mean, it seems weird that, you know, one and not the other, you know, so you have to think something's coming from Freddie, right?
Yeah. Oh, yeah. We haven't seen anything from Freddie. Rumor has it Freddie's going to come out with the same similar type thing. Usually they're in tandem with each other. So I think that will be coming out, I would guess, anytime now.
And it shocks me that not all the aggregators have made any adjustments yet. We call them aggregators because they are aggregating volume that is typically being securitized. Yeah. Fannie and Freddie, who are putting these restrictions in place. So if you're one of the large aggregators, I'm assuming they're going to be held to the same 7% threshold as Success Mortgage Partners or any lender. But yeah, I mean, the risk of being adversely selected, right? I mean, I would imagine right now, you know, any aggregators that have not put anything in place for, you know, lenders that have more than 7% in their pipeline, you're furiously locking them in right now, right? With the people that have no hits.
Yep, absolutely. So I think it's just a matter of time before they make that difference, you know, that change. But I also think that when they make the change, they'll just make it immediately. So when we sent out, you know, the announcement to our team, of course, our loan officers are trying to lock the loans, you know, trying to not take the price hit, which they have to. We already have loans that we've closed that we're selling, that we've got to look at where we're selling them to, trying not to get the price hit. It's a little chaotic right now. I am sure in the next couple weeks, it will definitely simmer down and we'll be able to get a good plan together. But those aggregators are going to come out with the price hit because they're going to get every single loan that's a investment or a second home if they don't have a price hit. You know, and the other thing too is I think Fannie needs to come out with a little bit more guidance too, you know, with them coming out with this and then calling independents and saying, okay, what's your plan on, you know, your investment and second home, you know, volume. I think they're just trying to figure out how much they have, what their exposure is, and how that they're going to handle it, let alone be able to respond to Fannie Mae without real clear direction. So never a dull moment.
Never a dull moment in the mortgage industry. And it seems strange that it wasn't coordinated with Fannie and Freddie together, considering they're regulated by the same entity, number one. Right. And the aggregators, I would imagine the one, because we saw this right in mid-March when the pandemic hit and the aggregators began just furiously, saying we're not buying loans that, with the whole
Massive FICO score. Yep.
yeah. And then it was just like, it was like a very quick domino effect. Everybody did it within days because of the fear of being adversely selected. So, and the timing, of course, is, less than optimal. I mean, we're heading into spring purchase season. You've got a lack of inventory. In theory, you've got a lot of owner out there, right? People that own investment properties or second homes, they're, they're looking to add more of them than they are to get rid of them at this point, you would think. So craziness as usual in the residential lending industry. So
yes, we all seem to adapt though and get through it, but it is a little crazy. So I do think Freddie's going to be coming out with something. And I do think those aggregators that we talked about that don't have a price set, I firmly believe they're gonna come out with one.
Do see a note that came in the chat. FHFA put the limit on Fannie and Freddie. Fannie hasn't come out with anything official other than no LP waiver or manual. Lots of hints that future changes will come if total book doesn't come down. So it'll be interesting to see what that happens. I think there is more of that product out there than the limits that were put out there. So I don't know if that all of a sudden becomes like essentially non-QM or non-conforming product all of a sudden. Be interesting to see how it plays out. So all right, turning our attention to the state of Michigan, where certainly no shortage of news that has come out. You'd have to be living under a rock or in a coma to not know the recent trials and tribulations with Rocket and United Wholesale, and you got the third biggest wholesaler in America, Home Point. It's stayed out of the mix. They're up in Michigan as well.
Yeah.
I don't know really of anybody that's more dialed into the Michigan mortgage banking scene than you. You're the president of a, very nice sized independent mortgage banking firm. Would love to just hear your perspective on this whole soap opera, what you're hearing and seeing, and just kind of pick your brain on everything going on up in your state.
Well, it's exciting here in Michigan. Both those companies are 20 minutes from us either way. Both of them are very well-run companies. It was interesting when United Wholesale came out with, their stipulation. They gave the broker community about a week and a half to sign an addendum, which I guess I was a little surprised that Fairway was looped in there too, but that was education for me. But, I think the broker community, they're smart owners. They have to make the best decision for them. But I put myself in the position like, we sell to Wells Fargo, we sell to AmeriHome, we sell to Fannie Mae. And if Wells Fargo came out tomorrow and said, hey, you can't sell to Fannie Mae or AmeriHome if you're going to sell to us, I mean, that'd be a tough decision for us to make. One, what kind of products and services do they offer that we have a customer base that we sell to Wells Fargo? Besides the fact that nobody really likes to be told what to do, because we're so heavily regulated anyway. But then on the flip side, what's the financial aspect for doing that if you're a broker? I did hear a pretty high percentage of the broker community did sign those addendums with UWM. But I just thought it was an interesting stance that they came out with it. I feel like a lot of people that do TPO do retail business as well. And just like for us, if you read any investor contract, if we sell a loan to Wells Fargo, if we sell a loan to AmeriHome, they think that's their loan, right? You're selling that loan to them and the servicing rates. Now, I would love to say that we would love to refinance them, but that's why the investors put the EPOs in place. So it's just interesting how it's going to shake out. I will say, anytime that UWM and Quicken go toe-to-toe, we see them get very competitively priced. So since they're right in our backyard, we're seeing LEs coming out from Quicken primarily that the rates, they have to be doing them at a loss. I mean, we can't even get those type of rates, let alone pay for all the closing costs. So that is one downside with them being in our backyard. We definitely feel a little more rate pressure because those two are going toe-to-toe for business. But it'll be interesting to see how it shakes out.
Yeah, I saw a column that came out today, UWM claiming the 10,000 brokers have already signed the addendum. Of course, they, failed to list any of them or provide any, data or context around that. But the beautiful part about all this, and, if you're just, on the sidelines watching it, is these companies are both public companies right now. So,
Yeah.
self-serving press releases about, how many brokers have done it or how many haven't. It's all public. So we're going to get to see this play out publicly as earnings come out each quarter. And yeah, it'll be good theater to be sure. But I had heard the same thing you had just said from another member of ours in Michigan, just that, seeing some very crazy LEs that you can't compete with, and
Right.
that anytime those two are going heads up, that it's just silly season on the rate quotes. But the one thing about that is, I mean, UWM is all wholesale. It's a lower margin business, obviously. Rocket's got a more diversified business strategy and channel strategy. A little easier for them to play that game than UWM. I mean, if UWM, and I guess now it won't matter in theory because anybody that sells them can't go to Quicken or Rocket, but craziness. So
Yeah, it is interesting. And I don't know for how long that addendum was for. Is it for a year? Is it forever that you can never sell to them? So it'll be interesting to see how that's enforced. Like, how would they really know? But I'm sure they have a bunch of attorneys, I'm sure. But if I'm a broker and I sneak one over to Quicken, how do they really know? So we'll see. It'll be interesting to see how it plays out. It's just been interesting being in Michigan, with those companies right down the street.
let's just put it this way. I've gone back and forth with more than one broker on LinkedIn this week that basically said, we're going to sign it because we like doing business with UWM, but they'll never enforce it. It's unenforceable. And which really, I mean, think about it. I mean, even if they wanted to enforce it, it would just be bad, forgetting about the legal, tie up of it. It seems like something that is more window dressing than something that they plan to enforce, but who knows?
Yeah, definitely.
What about being in the same state with, the biggest wholesale lenders in America, just the whole kind of like, mortgage banker versus mortgage broker. I've heard more than one person from the broker community claim they're up over 20% market share. That is categorically false from everything I've seen. I've seen, it seems like between 15 and 18%. If you look at the credible sources that are out there, that would still put the broker channel at around its highest mix of the overall pie, at least in recent history. How do you, I know, like, a couple of years ago, there was when margins were really tight in the mortgage banking industry, and for everyone, there was a lot of loan originators that went to go do the broker thing. But I sense, like, honestly, like, my general sense is that mortgage brokers lost market share to mortgage bankers the last 6 months of last year. And I'm curious how you view that dynamic and how that could play out in 21 and 22.
I think they'll be interesting to see. I mean, we had one shop that turned over to be a broker, which was a difficult transaction for them. I think I've heard loan officers that have decided, okay, I want to be a broker, but with that comes compliance, audits. I sit on the mortgage advisory board for the state of Michigan. And one thing that's a very big gap for brokers, especially in the state of Michigan, that's great that you sell to United Wholesale or you sell to Quicken. You're still responsible for keeping your records. You're still responsible for maintaining all those documents. And it's funny because sometimes brokers will say, well, they have all the documents. Well, you're responsible still. So the state of Michigan is really trying to work with the broker communities to make sure that they understand the roles and responsibilities of being a broker. So it'll be interesting to see how it plays out. Now, I do know that Quicken had some great turn times, and so did UWM, turn in files within 24 hours in the summertime. I mean, for us as an independent, we struggled with the volume that we took in. But I don't know if the broker community is going to continue to grow. It'll be interesting to see. Now, from our perspective, we have converted a couple brokers to branches. just because they really just wanted to focus on what they do best, which is writing loans. They didn't want to be bogged down with all, the P&Ls and the audits and, compliance. So we'll see.
Should be interesting. Matt Ishbia has been, I think, very out there with his thoughts that, just with refinance going away, that his goal, that for his company to achieve the results financially that they want to, that they feel like the broker channel will go from, he's saying 20% right now, to 35% of the total pie within 5 years. But I mean, you look at Wall Street and what has happened with their stocks since they've gone public, SPAC phase, it got up to probably $13 a share and then has really gone in the tank. It's, $8 a share, $8.50 a share. So that is the investment community saying, I don't know if you can do that. So it'll be interesting to see how that all plays out. Will also be very interesting to see how shareholder opinion shapes the decision making of those companies going forward, because
right now, since they're public,
you go public, the good part is you raise a bunch of money, all the people like Mac get stinking rich. The flip side of that is you don't control your company anymore. So be interesting to see how that all plays out. So turning our attention to something you talked about at the Open, you guys hired over a couple hundred people last year. Success Mortgage Partners always has been a very tech-forward company. I know you guys have been building bots before. A lot of people even knew what the hell a bot was and how it could help a mortgage banking operation. Curious to get your perspective on, this is such a cyclical business, the mortgage lending industry, right? I mean, people are expecting this year to be another good year. But I think we've seen rates have gone up little this last month and volume's gone down a little bit, and not crazy down or anything like that. But our industry is so cyclical. At the same time, technologies are being developed internally by companies like Success and externally by a lot of great, emerging technology providers that will further lessen the human involvement on manufacturing a mortgage loan. So somebody that runs an independent mortgage banking firm, I'm just curious how you look at that dynamic first for this year, evening that out and staying productive, even though you've hired a lot of people and volume might be down a little bit. And then, more broadly going forward into the future as technology begins to play a bigger role.
We have created a lot of bots. We probably have 25 bots that are in production right now that we use every single day. Automation of a CD or, reading. We just started doing optic character recognition on the homeowner's insurance, on the title work, on cavers, on fraud guard, to really start picking up some of these major issues, like on a fraud guard, if they've had a foreclosure less than 3 years. Some of the automation that we have is really to help us scale without hiring 200 people. And one thing that we have to be very aware of, that when we're explaining to our company or explaining to our ops team, it's not to replace them. It's really to help them be able to scale more volume without doing oodles of overtime. One of the simplest bots that we have automatic orders the flood cert. It reads it. It'll set a condition if it's in a flood zone. It will send out the disclosures without touching anybody. So a couple other ones that we have in production is reading the credit report and alerting the underwriter if there's going to be an issue, or automatically setting conditions based on the type of loan that you have. So we really want to go into that almost artificial intelligence to really be able to help us scale, because last year was tough. I mean, we hired a lot of great people, but we had to pay a pretty price to get people in the door. And we've done this college program a couple times, and we really want to be able to hire people that maybe don't have experience, but we can give them a portal to help them ramp up. Because if we build a better mousetrap, they won't make the mistakes that we might have, if there's not a hard stop in the system. So we program them in-house. We have 5 programmers that we have on staff. They're coders and programmers. And each department, we have probably 200 different automations that we're trying to build, anywhere from reading the CD that comes back from the title company to automatically update Encompass and then send the package. So we have a lot in the test phase right now, but it is helping us be more efficient because we really want to focus on getting more output per person. And the only way to really scale that is through automation.
We had a couple of questions and comments come in the chat just about, are you using vendors or in-house? But we know you're doing it in-house. I know you guys are looking at some external stuff as well on the emerging tech side. One of your principals, Owen Lee, is very involved with our emerging technology fund at EMC, which is a cool thing that we started last November. That's a fund for our members to assess and potentially invest in next level technology providers to supplement. And it doesn't mean, like, I think you guys are a good example. You guys are not counting on that at all. You're hiring developers and building your own tech solutions in-house at the same time, very much on the forefront of assessing the emerging technology landscape and third-party providers that could be helpful to your organizations as well. So,
you know, it was interesting last year because we grew so much in 1 year. The nice thing about doing that, the positive, was it allowed us to test the bots that we have with volume. And we realized that some of them that we had to add more bandwidth because they couldn't handle all the volume. So the good thing with last year is I felt like we advanced a couple years forward because normally we wouldn't do that large of an increase in 1 year. But we have the buy-in from everybody that works here, which is what helps us. You know, we created an email address, for ideas. So we get, junior processors, underwriters, loan officers, everybody that sends us ideas on how to streamline the process. One thing that we've told them for efficiencies, if it's something that's done in repetition, you can create a bot or a program to do that. So that's one of the things that we've done. And when they get to, they come up with the idea for the bot, they get to name it. So all our bots have fun little names.
That's cool. This is the last week in mortgage today. I'm Rich Swervinsky with the Mortgage Collaborative. Just a couple minutes left with Success Mortgage Partners President Allison Johnston. And Allison, a lot of companies talk about, oh, we need to work with colleges and bring in young people. And it's like, to me, one of those things that a lot of people in our industry talk about and don't actually do. I'm curious to get just your perspective, like training. How has that worked for you guys? Like any tips or tricks on best practices in and around taking somebody that maybe is younger or doesn't have mortgage industry experience, getting them from point A to point B, especially in this, virtual world we're in?
Yeah, virtually was a little more difficult this year because usually we try to do it in person, but we did the same type of concept. We gave them 1 week crash course just in mortgage. I mean, they really don't have an idea on how it works. So we gave them a basic mortgage 101, and then we've rotated them with departments. Like my entire verification team is all college kids that had no experience. But we will rotate them through our departments and they'll stay for a couple weeks just so they can try to put some pieces together. And then based on their background, we try to be able to place them in something that maybe their field is in or they have a desire to do it. We usually have about 80% of the college kids that make it through all the way. Some might have other plans, but some of our traders that we have right now that do all our whole loan training were college students 3 years ago. So we've been able to give them a path. And first of all, communication is important. This is what are they interested in? What growth plans do you have for them? Because I think that communication is important. But it's worked out well. I have a couple that are junior underwriters. I've hired people without experience that might not be college kids, but one of our best closers is one of the closers that I hired from Kohl's. It was the weirdest thing. She was complaining about her job and she's like, I want to get in the mortgage industry. And my daughter's like, are we really doing this? At 11 o'clock at night? I'm like, yes, would you like a job in the mortgage industry? And you know what? She did retail for years. So she was very good with the loan officers and we were able to teach her how to close loans. And it worked really well because you can teach them exactly the way you want it done, and they'll do it exactly that way. So we've done it 3 years in a row. We love it. I'd really like to launch one on the sales side. Most of the positions we've had are on the ops side, but I'm very interested in doing it for the sales side as well.
Allison, as always enjoy the conversation, have really an immense amount of professional respect for you. And it's been great watching you just lead success through all the growth and success, no pun intended, that you guys have had. And I really appreciate you joining me again this week for the conversation.
Thanks so much. I really appreciate it. Great to see you.
And to all of our attendees, thank you all very much for joining us every Tuesday at 2 p.m. Eastern, the last week in Mortgage Today. And also we have open registration for our summer conference. It's so great to say those words, my God, at just this ridiculous resort outside of Los Angeles called Terranea. Go to mortgagecollaborative.com and you can see all the info on that event, which is in late September. And with that, I bid adieu and have a great week, everyone. Take care.
Thank you. Take care.